problem 3 on Connect is exercise 913 in your text. And this is probably the most mathy and the most finance heavy problem I'll assign all semester. And the only reason I've asked you to do it is you're graduating from one of the best business schools on the East Coast. And I may be a little prejudiced, but not by much. And your employers are going to expect you to be able to look at these things. Now, I'm not expecting you to memorize these ratios. I'm expecting you to know what they mean when you look up how to do them in the future. So, we're given some information here, and we're asked, and this is a fictional company, this is not the Duluth Trading Company that makes the jeans and stuff. And they're asking us, based on this information, and they give us the assets from the balance sheet, and they give us the liabilities and shareholders' equity. These two together form a complete balance sheet. And it says, using this information, which is readily available for publicly traded companies, compute the current ratio. Well, current ratio is current assets divided by current liabilities. Let me show you what the current assets are. Current assets, and you may have had to look this up, and that's fine, is cash, marketable securities, accounts receivable, and inventory. They're things that you can turn into cash relatively quickly. They are all current assets. And when you add those together, you come up with $154,000. So our current assets are $154,000. So that's the first part that we need. $154,000. And we have to divide it by our current liabilities. And current liabilities are liabilities that you will pay within the year. So that's accounts payable and current notes payable. It doesn't include the mortgage, bonds, none of that, because they're payable beyond the year. This is $30,000, not $39,000. That's a comma, not a 9, okay? $30,000. So we'll divide our current assets by 30,000, and we come up with a current ratio of 5.13 to 1, and that says that we have $5.13 for every $1 in current liabilities. That puts us in pretty good shape. The next question it asks is earnings per share. And that question's deceptively easy, so you probably chased your tail for quite a while before you figured it out. Net income for the year was $40,000. 40,000 net income is another word for earnings, and we had 880 shares outstanding. So earnings per share is net income divided by number of shareholders. So it's net income divided by shareholders. So we have $40,000 in net income right here. We have 880 shares. right there. Do the calculator dance. And we're told that the net income could have given, did not necessarily give, probably didn't actually, but could have given each shareholder $45.45 at the current earnings rate. Now, the quick test, the acid test, this is also called the banker's test. You have to go back to your textbook and look that up. Or, again, go to Dr. Google, everybody's best friend, Dr. Google. And assets, you have to go to the balance sheet. But now we're looking for the quick ratio, the quick assets. These are assets that can be quickly turned into cash. Well, cash, marketable securities, and accounts receivable. They're the quick assets. Because you can turn those into cash basically with a phone call. Inventory you have to sell. That takes a while. Securities you can sell with a phone call. Call your broker, say, sell my shares of XYZ. Accounts receivable, again, you can turn that into cash either by selling the receivables through a process called factoring or by calling your customers and saying, hey Charlie, could you send me the money you owe me? I'm in a bit of a jam. So they're the quick assets, or the acid test assets, or the banker's test assets. They're the ones that can turn into cash quickly. And if you add those up, you come up with 110,000. So, we're still taking the 110,000. We're using the same current liabilities, the same 30,000. And you're saying, how much can I raise quickly to pay every dollar of liabilities that come in? This number will always be smaller than the current ratio. Always. So it's the quick assets, which I will abbreviate QA, divided by the current liabilities. So that's 110,000 divided by 30,000. And when we do that, we come up to 3.67 to 1. Notice that that's less than the current ratio, but it still indicates that we have plenty of assets to honor our liabilities as they become due. Now, return on investment is simply a matter of looking at return, and return is another word for income. Again, that would have sent you scurrying off to Dr. Google, and that's okay. I like when you scurry off to Dr. Google, because that's something, a skill you'll have with you forever. So you scurry off and you find out that net income also means earnings, also means return, all mean the same thing. So let's take a look at our $40,000 of our return. Which is net income. And our investment, let's take a look at our shareholders' equity section here. The total investment, the total that both debtors, creditors, and stockholders have put into our company? 400,000. So we want to know, we want to be able to tell our creditors and our shareholders roughly what percent are we making on your money. How much return are we making on your money, Mr. Lender and Mr. Owner, or Miss Lender and Ms. Owner? So we take the 40,000, divide by 400,000. So this is liabilities plus equity. That's investment. And we come up with 10%. So we can go to the people who provided our capital, our lenders and our investors, and say, we're using your money and we are returning 10% on each dollar that you have entrusted to our company. That could be very good, that could be very bad, it could be spot on. Again, remember, go to every tent in the bazaar. Don't look at just one number. And the next number we want to talk about is return on equity. And the return on equity is just looking at net income divided by the equity, and that's just common stock and retained earnings. That's the only thing that counts as equity. Common stock and retained earnings. And there may be questions like this on your exam. It would not hurt to have these written down on a note card so you have these quickly at hand, so that if you need to go and look at the formula to get the relationships, you can. So the net income there is still 40,000, but the equity is 319,000. Which I'm going to put at 12.54%, but I know some of you are precision folks. If you want the full 10-digit number, there it is. I think that's a little excessive since we're basically talking about dollars and cents, but 12.54% is the return on equity. Now, the last number we need to talk about is the debt to equity ratio. So let's take a look at our debt. We're going to get that from our income statement. And our total debt is all of that. That's our debt. Okay? So we're going to look at our debt, which totals 81,000 if you add it up. And we're going to divide it by our total equity, which is 319,000. So our debt to equity ratio is going to be 81,000. That's all the liabilities divided by the equity, the debt to the equity. That's just looking at that half of the balance sheet. So 81,000 divided by 319,000 gives us a debt to equity ratio of 25.39%. So these ratios, you'll be expected to interpret these and understand these. Your future employers will expect that. I don't expect you to memorize them. I expect you to know how to find them and what they mean. Okay, how to interpret them, how to talk intelligently about them. I'm not asking you to become finance majors and memorize all this stuff. I don't have a lot of it memorized. I can do it because I've been doing it probably longer than most of you have been breathing. But the important thing is to know where to get the information, and once you get it, what does it mean?